If you were asleep, you missed it. The silver market just broke, not a correction, not a rally, a break. While you were resting, the East printed $100 per ounce on silver, and the mainstream financial media, your CNBCs, your Bloombergs, they're calling it a glitch, a localized anomaly. They're hoping you'll scroll past it, go back to checking your retirement accounts like nothing happened. But I've been staring at these screens since 3 a.m., and I'm telling you, the screens you're looking at in New York and London are lying to you. This isn't just a price move. This is a regional decoupling. And it happened overnight while most of America was asleep. History was made, the kind of history that won't make headlines until it's already too late to act. I'm not a YouTuber. I'm a private commodities analyst who spent the last 12 years trading physical metals and tracking vault flows that most retail investors will never see. Here's the reality. That $100 print in Shanghai, that's just the smoke. The fire is what's happening to Western vaults right now, and it's moving faster than anyone predicted. Physical metal is bleeding out of the COMEX and LBMA at a rate that should terrify anyone holding paper contracts. The arbitrage gap, it's $13.89. That's not a spread, that's a chasm, a market that's lost its structural integrity. Let me be clear, this isn't some typical bull market hype. I'm not telling you silver's going up because of a chart pattern or some Fed policy. What we're seeing right now is a structural price reset, not a rally, a reset. And that gap between East and West is forcing a physical drain that the paper market simply cannot stop. They can print contracts all day long, but they cannot print bars of silver. Now, here's the part you need to understand. Gold's been climbing steadily for 77 days, but as of just hours ago, silver is the new leader. It outperformed gold by nearly 4 times overnight. When silver starts outperforming gold at that ratio, you're not in a normal market anymore. You're in the parabolic phase, the phase where things move so fast, by the time the mainstream media figures it out, the opportunity is already gone. I'm promising you this. In this video, I'm going to walk you through the Shanghai premium mechanism that just shattered the COMEX. I'll run the conservative math on the gold to silver ratio and share exactly how I'm positioning my personal portfolio for $130 silver reality. Not speculation, not guesswork, hard numbers that the mainstream media is too afraid to share because it would expose just how fragile the entire Western pricing structure really is. This isn't about trading. This is about the survival of physical supply in the West. But before we dive into my personal strategy, let's look at the numbers that confirm it all. Let's start with the hard data from 3 a.m. this morning. The snapshot I pulled. Here's the truth. Gold spot price, 4,624.39. It's testing the upper boundary of that 77-day rising channel I mentioned. Everything's steady, disciplined, exactly where it should be if we're in a normal bull market. Silver spot price, 89.88, up 2.34% while the world slept. That's the New York price. That's the London price. That's the price you see when you check Kitco or any of the standard Western data feeds. But here's where it gets interesting. Shanghai silver, the price being paid for physical delivery in the East, is at 103. Let me say that again, 103. That's a $13.89 gap between New York and Shanghai. This market, it's been split in half. Think about that for a second. If you can secure physical silver in New York at $89 and ship it to Shanghai, where it's trading at 103, you just made a $13 arbitrage profit per ounce, minus shipping, insurance, and all the international logistics headaches. But even after that, you're still clearing $8 to $10 per ounce on a pure arbitrage play. That's free money. And when free money appears in the markets, smart money moves fast. But here's where the momentum really starts to shift. Take a look at the gold to silver ratio, which is sitting at 51.4 right now. For those who don't track this, it tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this number has fluctuated between 50 and 80 over the past 2 decades. When it's high, like 80 or 90, silver is cheap relative to gold. When it's low, like 40 or 30, silver is expensive relative to gold. Right now, we're at 51, but the momentum, it's vertical. The ratio is collapsing and fast. Gold moved up 0.6% overnight. Silver, a massive 2.34%. That's a 4-to-1 outperformance ratio. When silver starts moving 4 times faster than gold, you're no longer in a normal market cycle. You've entered the parabolic phase of the precious metal cycle. And trust me, this is the phase where retail investors wake up, check their phones, and realize they missed the entry point by weeks. And here's what's keeping me up at night. If the West doesn't close that $13 gap by the time the New York session settles today, something's going to snap in the physical delivery system. The COMEX runs on a fractional reserve model. They hold a certain amount of physical silver in registered vaults and issue contracts worth many times that amount. It works as long as most people settle in cash. But when an arbitrage opportunity like this opens up, people stop settling in cash. They demand delivery. They take the bars and ship them east. And that's when everything starts to crack. The system's fragile. Now let's talk about arbitrage dislocation, the mechanism that's driving all of this right now. If you're unfamiliar with this, let me break it down. Arbitrage is simply buying low in one market and selling high in another. It's the oldest trick in finance. But when the gap becomes so massive like it is right now, the physical supply starts bleeding out of the cheaper market and flowing into the more expensive one. It's not just numbers on a screen anymore. This is actual movement of physical goods. We're talking bars of silver being loaded onto planes and ships moving across oceans. Think of it like two gas stations on opposite sides of the street. Station A sells gas for $3 per gallon. Station B, $4.50. What happens? Everyone lines up at Station A, filling up everything they can find. They keep filling up until Station A runs dry. Then Station A has two options: shut down or raise the price to match Station B. The COMEX and the LBMA, they're Station A right now. They're selling silver for $89 while the East is paying $103. Smart money. They're lining up, buying every ounce of silver they can at $89 and shipping it east to sell at $103. And this isn't some theoretical scenario. I've seen the vault drawdown reports. Registered silver at the COMEX has been bleeding for weeks, and it just accelerated. But here's the kicker. The COMEX can print all the paper contracts they want. They can issue 1 million ounces worth of futures contracts in an afternoon. But they can't print physical silver. They can't conjure bars out of thin air. And when that arbitrage gap hits $13, people stop trading paper. They demand metal. And when that happens, the whole structure starts to crack. Let's talk about why this is a trap for the exchanges. The COMEX can issue paper contracts all day long, but they can't control what's happening with physical supply. This is the critical part you need to understand. The more the gap widens, the faster the physical silver drains. And once it's gone, there's no going back. Now, let's test the numbers. Let's run the conservative scenario first. If the gold to silver ratio simply stays at 51, gold stays at 4,624, then silver's fair value is already at $90 in the West. That's the baseline, the nothing crazy happens scenario. But let's stress test it. Some analysts like Rashad Hajv and others have been calling for a gold to silver ratio of 40, not 51, but 40. If that happens and gold stays at 4,624, then silver could instantly hit $115.60 per ounce, just from the ratio compression alone. No movement in gold required, just the ratio tightening. And we're already seeing that ratio collapse. But here's where it gets even crazier. What if silver simply resets to match the Shanghai price of 103? If the West just catches up to where the East already is, the gold to silver ratio drops to 44. We're already halfway there. The gap is closing, whether the Western exchanges want it to or not. And this is where the 1389 bomb drops. That's the pressure currently pushing against the Western price ceiling. Every hour that gap stays open, more metal drains east. Every day, the COMEX refuses to let the price rise to meet Shanghai. They lose more registered inventory. They're bleeding out, and they know it. So here's what we know. The East has hit $100. The West is lagging by 13. The physical supply is being drained out of New York and London. The gold to silver ratio is collapsing. The numbers don't add up. And yet, if you turn on CNBC right now, they'll tell you everything is fine. They'll say this is just a bull trap. They'll trot out some analyst who will explain why $90 silver is unsustainable. But here's where we need to pause. What if they're wrong? What if the entire system is about to implode? Let's steal the skeptics' argument for a moment. They'll say the Shanghai surge is just a temporary liquidity spike caused by Chinese New Year demand or some odd quirk in the Shanghai Gold Exchange. They'll argue that $90 silver will destroy industrial demand, things like solar panels, electronics, and create a massive supply glut that'll crash the price back to the $70 range. Then there's the US dollar factor, the DXY, the dollar index has been relatively stable. But if it suddenly rallies, it could break gold's 77-day rising channel and send silver tumbling back into the 70s. That's the bear case. There are real concerns, but here's my rebuttal, and it's based on 12 years of watching this market. Industrial demand is inelastic in the short term. Solar manufacturers don't just stop using silver overnight. They've got supply contracts, production schedules, panels already in mid-assembly that need silver paste. They can't just swap silver for something else within 2 months. You can't move that fast in the industrial world. And the physical drain to the east, it's already happening. The demand isn't disappearing. It's being relocated. The silver that was meant for Western industrial users is now being diverted to Eastern buyers who are willing to pay $13 more per ounce. This isn't a demand problem. This is a price problem. Now, let's crush the idea that paper shorting can stop this. I've seen this argument 100 times before. The bullion banks will just short the futures market, they say, and crush the rally. And yes, they can do that. They can issue short contracts and suppress the paper price for a while. But here's the issue. In a physical arbitrage situation, a paper short is just a promise to deliver metal that's already been shipped to Shanghai. It's a naked position, a bet that you'll find the metal to deliver when the contract expires. But if the metal's already gone, if it's already halfway to China, there's nothing to deliver. That's when you get a short squeeze. The shorts can manipulate the paper price all they want, but they cannot manipulate the physical flow. And right now, that physical flow, it's moving east. There's no stopping it. If the skeptics are wrong, and I believe they are, the institutions have only one move left. They'll have to change the rules of the game. So what happens next? Let me walk you through what I expect to see in the next few days and weeks based on historical patterns and what I'm seeing in the data right now. First, we'll likely see massive margin hikes on the COMEX. This is a classic move. When the exchange feels threatened by a short squeeze or a delivery crisis, they raise the margin requirements. Suddenly, you need 50% more capital to hold the same position. Retail traders who are leveraged get margin calls, they panic, they close their positions, and the price drops. The institutions breathe a sigh of relief. Watch for that. If you see the COMEX announce a margin hike of 30%, 40%, or 50% overnight, you'll know they're scared. You'll know that delivery requests are piling up and they need to shake people out before the situation spirals out of control. Second, media blackouts. The Shanghai numbers will start to become unreliable or subject to review. Suddenly, those premium prices won't be making headlines. Western financial media will focus exclusively on the New York spot price. They'll try to memory hole the arbitrage gap. Don't let them. Here are the specific indicators I'm watching. First, the $91 breakout. If New York opens today and pushes past $91, the catch-up is officially on. That's the signal that Western markets are acknowledging the Shanghai premium and beginning to close the gap. If we clear $91, we're heading to $95 fast, then $100, and then $110. Second, the gold to silver ratio at 48. Right now it's at 51. If we cross under 50 and hit 48, the decoupling is permanent. That's the point of no return. Even the skeptics will have to admit that something fundamental has changed in the market structure.